Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Turning down the heat while U.S. manufacturing data comes in soft, easing bets on Fed tightening. The RBA hikes half as much as expected, bashing yields and the Aussie dollar. Seeking calm, UK Chancellor Kwasi Kwarteng is set to bring forward his fiscal plan, looking to reassure markets after that embarrassing U-turn yesterday. Plus, crisis of confidence, Credit Suisse shares jump despite investor uncertainty over how the bank will actually pay for its restructuring. Now, let's check on the markets because there is quite a lot going on in the markets. European stocks, but also U.S. futures pointing to a higher start. Now, they're extending their advance that really started yesterday. This is as that weak U.S. manufacturing means that there's a bit of repricing going on how the Federal Reserve, how hawkish the Fed can actually be. The FTSE 100 getting 1.3%. If you look at the sectors, most of them that make up the 19 groups that make up the S&P 600 are actually gaining. The U.S. dollar 3,205. We use the U.S. dollar Bloomberg index. And then the Australia 10-year yield, 3.73. This is after that reversal from the RBA. Many people saying that actually this is something that the Fed should also pivot to. Otherwise, we're going to see messy bond markets. All right, let's get to the European map, if we have it, just to see if we have a difference between France and Germany and the like. Our Maria today was also in Luxembourg looking at the energy plan. For the moment, we're seeing gains across the board. So the Aussie dollar and bond yields tumbling after the central bank hiked less than expected. It follows the S&P 500 yesterday, ending its best session since July, as investors paired expectations of how aggressively the Federal Reserve will hike following weaker than expected manufacturing data. Now, Yardeni Research President Edward Yardeni says the Fed should actually end tightening after one more rate hike.
I'm totally stumped, mystified, surprised that Fed officials don't seem to acknowledge that just focusing on the Fed funds rate as part of the monetary tightening cycle is a mistake when you also have QT2 and you have a soaring dollar. These are very restrictive monetary developments. I think they got one more rate hike coming in early November, and that'll be it because the financial stability issue will pop up as primary concern.
Well, we're now joined by Morgane Deladon, Head of Investment Strategy for Europe at Global X ETFs, and Christine Aquino from our markets team. So thank you both for joining us. Christine, I don't know what does the Fed look at the RBA and say, maybe I should learn something from them?
It's probably a little bit of that element, Francine. But, of course, these are drastically different economies, right? I mean, the Fed and the U.S. economy is one thing. But, Australia is very much a small, open economy. It's very exposed to the global gyrations in growth and inflation and monetary policy. And so it makes a lot of sense that they're now kind of, I suppose, easing back a little bit from that really fervent tightening stance earlier in the year, probably looking towards what's happening in China, of course, their biggest trading partner as well. But there is something to be said about, a small central bank kind of trying to pave the way for a bit of a pullback now in tightening policy.
Yeah, so forget peak inflation, Morgan. Have we reached like peak interest rate hikes?
Very good question. I think it's hard to say right now, but it seems that the risks are more to a dovish turn towards the end of the year rather than more hawkish surprise from central banks. If you look at the current pricing, one thing is quite obvious is the US is doing better relatively to other regions on the economy front. So the real question is, will the Fed reach peak hawkishness now? And I think it's likely to be the case. I think the differential between interest rate in the US and Europe, for example, will remain stable.
So, Morgan, what would you be buying right now?
So definitely positioning more on the defensive side. I think there is a case now to look at a more barbell approach with some short-term exposure and long duration potentially as yield curve become more inverted. So looking at this for the bond market. In the equity market, staying allocated to more defensive sectors, consumer staples, healthcare seems to be still a quite interesting sector at the moment.
And Christine, I mean, you see definitely assets getting a bit of relief now, but how long can the dollar easing last?
Yeah, big question, Francine. I mean, I think a lot of that will depend on some of the key data coming up in the U.S. Jobs Week, of course, we know that usually does turn the tides when it comes to what the Fed is going to be doing next. So that's very key. But I think it's quite interesting because, you know, it does feel a bit like the peak is a little bit past us now in the dollar, just because of what you're seeing in the U.S. economy as well, right? I mean, we're starting to see signs of, for instance, of the housing market starting to roll over from its very frothy levels over the summer especially. And so just some of these key economic indicators kind of maybe giving the Fed some reason to maybe hold up a little bit on that very fervent easing stance that they had earlier this year.
Yeah, and of course, at the heart of some of the current market turmoil is also what we see in terms of recent surge in gilts, especially at the long end. Now, shares in Credit Suisse also trading higher today, just one day after touching a record low. The Swiss lender's credit risk gauge jumped to an all-time high on Monday after the chief executive failed to calm markets on capital levels and liquidity. So joining us now to talk about all this, and then we'll go back to Christine and Morgan, is Steve Ahrens. Steve, so first of all, how serious is the danger to Credit Suisse?
Well, hey, Francine. I mean, it's a very serious situation. If the CEO keeps sending out internal memos to staff to reassure them, there's something going on, right? They've said they're going to update on the strategy at the end of this month, along with three-quarter earnings. But the markets are so tense. I mean, there's so much uncertainty generally, but particularly about Credit Suisse. There's a lot of pressure on the bank now to maybe say something earlier than that. So if they want to head off all the volatility that's going on in their share price and their CDS too, they will have to do something, and so the pressure's on.
And so, Steve, the worse the market gets, right, the worse the options for Credit Suisse are. So how fast do they need to act?
Well, like I said, they're giving themselves really until the end of the month, but it seems like there's so much anxiety now, so much speculation. I mean, Bloomberg, we've had a lot of scoops on what could happen, and there's a lot of other media out there chasing this. There's a lot of speculation. There's a lot of stuff on Twitter. There was a tweet that set off speculation. There's so much going on. It's just a personal guess, but I think the pressure is so strong they may have to do something before actually the end of this month.
All right, Steve, thank you so much. Steve Ahrens there looking at Credit Suisse that we're dubbing Crisis Suisse. It must be pretty depressing if you're one of those trading floors. Christine, again, is this symptomatic of something that Credit Suisse is living through because of the specifics of the bank, or could it actually turn into something worse for the banking sector as a whole?
I mean, it sounds like the bulk of the issues are quite idiosyncratic to Credit Suisse, as we were discussing earlier, Francine. But, it's probably symptomatic of the broader environment in the sense of it's a more difficult environment for banks and businesses in general, right? Because it's quite a lot of uncertainty with regards to where interest rates are going and how high that's going to go. And then also, on the other hand, a lot of volatility in market trading, which usually is a good thing for banks, especially when it comes to their trading books. But then also with that comes some weakness and uncertainty in investor and consumer activity. So all of these put together, it really is quite a challenging environment for banks in general. And it could be something where, at the end of all of this, we will see quite a bit of differentiation between some of the stronger links in the sector versus the weaker links, as we're seeing with Credit Suisse.
Yeah, is that your take as well, Morgan, that this doesn't necessarily snowball into something bigger?
I think what we're currently seeing is a change from a month ago is other asset classes than bonds are pricing higher in recession risks. And we definitely see more volatility in the equity market, but also other asset classes, especially in the precious metals. Gold has rebounded, silver has rebounded. So there is a sign that the market is preparing for more turmoil to come, as also central banks are about to step up their quantitative tightening. So reduced central bank liquidity is probably adding fuel to this nervousness.
Yeah, and Christine, I mean, on that, is there a danger that actually this lack of liquidity will really exacerbate some of the moves like we saw maybe 8-9 months ago, that, this is the pipeline. We don't usually worry about it, but can it be, turned into something that's a market event?
That's certainly always in the back of minds of investors, right? I mean, this is something, for instance, really cropped up as an issue at the height of the pandemic, and that's where we saw central banks really step up their ability to manage short periods of liquidity stresses. And you would hope that some of those preparations that we saw a couple of years ago would still be in place and would be provide quite a robust source of liquidity at the moment. But again, a lot of unexpected events this year that really hampered a lot of parts of liquidity in the market. I mean, the Russia situation still undergoing, and that has really kind of brought up some of the stresses that were reminiscent of the pandemic era. And so I think we will see kind of tests of liquidity in terms of high stress periods, but not necessarily a breaking point.
All right, thank you both for joining us. Morgan Deladon there, Head of Investment Strategy for Europe at Global X ETFs, and Christina Kino from our markets team joining us today. Now, coming up, warnings over the Prime Minister Liz Truss's credibility will go live to the UK Conservative Party conference. For more, that's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, some members of Liz Truss's top team say the UK Prime Minister will struggle to drive through key economic policies because her standing within her Conservative Party is already so damaged. Let's bring in Bloomberg's Lizzie Burden, who's at the Conservative Party conference in Birmingham. So, Lizzie, are these policy reversals enough to calm markets?
Well, let's be clear, the top rate of tax reversal is a move that's political. It was becoming politically toxic. What is more for markets is this reversal on the OBR forecast, the Office for Budget Responsibility assessment, which didn't come when the package was originally announced, remember, and that seemed to undermine the credibility of the announcement in the eyes of markets. But still, questions remain around how they're going to pay for all these tax cuts, which of course are effectively permanent, not like the emergency energy bailout. And it seems they're going to be paid for by lots and lots of borrowing at a time when borrowing is more expensive. That's what's offended markets. And in the interviews that we've heard from Liz Truss this morning, in Kwasi Kwarteng's speech yesterday, there did seem to be a little bit of contempt for markets. Kwarteng said that his fiscal plans had caused a little turbulence, an understatement of the century. And Truss, in her interview earlier on the BBC, was still blaming inflation and interest rate rises on international factors. She still can't seem to see that it's the uncosted tax cuts that have offended markets. And she's still refusing to give a straight answer on how she plans to restore market credibility.
Can Liz Truss, Lizzie, survive such a public policy U-turn?
I mean, it's a huge humiliation. Our colleague Kitty Donaldson has been speaking to cabinet ministers even, who say that maybe Liz Truss will last, but she's going to be a lame duck for the rest of her premiership. She's already been pushed around on the top rate of income tax, and that could continue on, for example, planning reform, the cap of bankers' bonuses. There had been, and what you may also see are more political explosions on benefits, whether benefits are going to go up in line with inflation, because the government's going to have to make deep spending cuts if it's going to balance the books. Again, this is going to be really politically unpopular. Bloomberg Economics analysis says that they're going to have to cut spending by more than George Osborne in the austerity years. So Truss faces some real difficult political hurdles ahead.
Thank you so much, Lizzie Burden there in Birmingham following the Tory party conference for us. Now let's get straight to the Bloomberg First Word News. Here is Leanne Gerrans. Hi, Leanne.
Hi, Francine. 2 European commissioners are calling for the issuance of joint guaranteed debt as the continent continues to face up to an energy crisis. Thierry Breton and Paolo Gentiloni wrote in op-eds in several newspapers across the region that the situation means Europe is at another crossroads. The EU's €1.8 trillion emergency package during the pandemic was the first time the bloc issued joint debt. Now, officials in Florida say 68 people were killed by Hurricane Ian as the damage bill mounts 5 days after the storm struck. President Joe Biden is scheduled to visit Florida on Wednesday to survey the damage from what he described as one of the worst storms to ever hit the U.S. One estimate says insurance losses could reach $57 billion. Ukrainian President Volodymyr Zelensky says liberating settlements from Russian occupation is now the trend as his forces press further into territory held by Moscow. According to Zelensky, the strategic eastern town of Lyman has now been fully cleared. The Kremlin says it still hasn't finalized the borders of the 2 of the 4 regions that it laid claim to last week after those so-called referendums. And the Japanese government has issued a rare warning to residents in remote islands to take shelter after North Korea fired a missile over its territory for the first time. Now, that was since 2017. South Korea says it was a medium-range ballistic missile. Japan says the projectile splashed down in waters in the country's east. Last week, North Korea launched 7 missiles, its biggest weekly barrage under Kim Jong-un. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, Elon Musk causes an uproar after calling for Ukraine to seek appeasement with Russia. What do the comments mean for Tesla? We'll get into that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now, the Tesla boss, Elon Musk, under fire for a series of tweets calling for Ukraine to seek appeasement with Russia to end the war. Now, the SpaceX founder and chief executive also called on Kyiv to give up Crimea for good. Now, for more on all of this, we're joined by our card czar, Craig Trudell. So, Craig, this is not really about Ukraine and, what should happen. This is about Elon Musk, who feels he can tweet about everything and anything. Does it, and actually Tesla shares are up 2% in pre-market. Does this hurt his business or does it help his business?
I think it's hard to say. It's certainly the case that people have kind of looked the other way or put up with his antics, going back many years, right? And we've republished a story from just a couple of months ago this morning about this idea that would-be buyers or customers of Tesla are sort of turned off by Musk, and I think we've seen more of that just in the last maybe say 6 months when his politics have kind of changed. In a
what was the quote
way.
of the day? I mean, there's a brilliant quote in this article.
Yeah, there's one of the consumer surveys that we cite in this story. Talks about this idea that it refers to this idea that the sort of worst attribute of the Tesla brand among a lot of those surveyed, people cited Elon Musk. And, one of the people who conducted this survey talked about this idea that, some consumers did tell them, I love my car, but I really wish I didn't have to defend my choice of car, because of the latest Elon Musk tweet. It was something to that effect.
But at the same time, he's a little bit enigmatic because he's also sent Starlink to Ukraine, so you don't really always know on what side of the fence he sits on.
Totally. I think he's tried to have it both ways here. It was really within a matter of days, maybe weeks after the initial invasion that he stepped up and sent Starlink terminals. He even sent generators and other products to Ukraine, engaged with officials in Ukraine about, the thank yous and your welcomes for sending this your way. At the same time, he's also talked about, he's joked about, people on Twitter supporting the current thing and talked about woke mind virus. So he wants to kind of chide people for, blindly supporting Ukraine. And yet, at the same time, he's very clearly inserted himself into this even before yesterday when he started doing this tweeting.
Many people won't know who the Volkswagen chief executive is. Is that not, though, any bad publicity, even bad publicity is good publicity kind of scenario?
That seems to be his bet. I mean, he clearly likes to be in the news. He likes to be, trending on Reddit, trending on Twitter. And there's really sort of no controversy that he shies away from, making himself a part of.
That's a very diplomatic way of putting it. Craig, thank you so much. Craig Stradell, an Elon Musk watcher. Now, a rally in global markets seems to be extending into a second day, lifting also U.S. indices or futures and European stocks. Investors wagering that central banks may slow the pace of monetary tightening. Coming up, we speak to the French Finance Minister, Bruno Le Maire. That's as ministers gather in Luxembourg to discuss the energy crisis. That interview up next, and this is Bloomberg. Turning down the heat, U.S. manufacturing data comes in soft, easing bets on Fed tightening. The RBA hikes half as much as expected, bashing yields and the Aussie dollar. Seeking calm, UK Chancellor Kwasi Kwarteng is set to bring forward his fiscal plan, looking to reassure markets after a pretty embarrassing U-turn. Plus, crisis of confidence. Credit Suisse shares jump, despite investors' uncertainty over how the bank will actually pay for its restructuring. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, European finance ministers meet for a second day in Luxembourg, with energy taking center stage. That's as they consider ways to tackle the crisis since Russia began cutting gas supplies. Let's head over to Luxembourg, where Maria Tadeo is standing by with the French finance minister. Maria, over to you.
Thank you, Francine. Good morning. And we're joined exclusively on Bloomberg TV by the French Finance Minister, Bruno Le Maire. Thank you so much for joining us today. This is a Eurogroup that has been, well, hectic, but also very interesting. And you can see there's some tensions building behind the scenes. But before we get into that, I want to get your outlook on the European economy, because the idea was recession is almost inevitable. But it seems to me the story is way more complex, but also more nuanced when you look at storage, when you look at demand destruction. So overall, how do you see things?
I remain pretty optimistic, even if, of course, we are facing difficult times. We have an unprecedented level of inflation since the creation of euro, which raises a lot of concern among our citizens, among private companies. But I will give you my strong belief. If we remain united, all the 27 member states, we will overcome those difficulties by mid-2023, I would say. The key point is to stand united. And that's why I really think that there is a need for a global action plan at the European level against inflation.
And can I ask you, you talk about solidarity, and well, I think I've heard you speak now in 24 hours 3 times, and it's a word that comes often in your speeches. When you say solidarity, when you say unity, is that a message to Germany? And what does a level playing field mean when you have 200 billion euros to spend?
It's a global message to all the member states. And, you know, solidarity is part of this European action plan that we are proposing against inflation. The first point is energy efficiency. We need more energy efficiency, which means that we need to reduce our energy consumption. And I really think that we must do better as far as the reduction of energy consumption is concerned. The second point, as you just said, is solidarity. I think that we could think about a proposal like the SURE mechanism that proved to be very efficient during the COVID crisis. We could have the same kind of mechanism against the consequences of inflation for the countries that are mostly hit by the consequences of high prices. I'm not talking, to be very blunt, about common debt issuance. I'm talking about a SURE mechanism, which means the possibility of raising money at the national level, but with the guarantee of all European member states. This would be the second point of this global action plan. And the third point is to have targeted measures, targeted support to private companies that are exposed to the international competition and that are paying too much for their energy.
So you come here with a plan based on everything that you said. Essentially, there's a
global French plan we have been discussing with the French president based on solidarity, a kind of SURE mechanism, targeted support to the private companies that are facing these high prices and that cannot support this, cannot face these very high energy prices, and of course the necessity of reducing our energy consumption.
But you're saying I'm not calling for a recovery fund, and that's important to clarify.
I'm not talking about common debt issuance or a recovery fund or something like that, because we know that it might raise some difficulty among member states, and there is a need to decide quickly. I'm not talking about an action plan on which we should discuss over the next month, over the next weeks. We must decide now, because inflation is hitting our economies, our citizens, our private companies, our industry right now. So there is a necessity for deciding in the coming days, not in the coming weeks.
And of course, President Macron met with Schultz yesterday, and they will meet again later in the week. But in your conversation with Christian Lindner, I spoke to him in the morning. He said, I don't see the need for more debt. I don't see the need of this big plan. We have what it takes for the time being. So essentially, you disagree.
That's exactly what I'm not talking about, common debt issuance. I'm just talking about the possibility at the national level to raise debt, but with the support and the guarantee of all European member states, which means that you could borrow money at the lowest price. And that's a key point for many member states. But of course, I've been talking with Christian Lindner yesterday. We are working very closely together, like President Macron did yesterday with Chancellor Olaf Scholz.
And can I ask you, that's on the European level where you make your points very clear. You have a plan, and
I made these points very clearly yesterday, explaining that we should not underestimate not only the financial, not only the economic, but also the political consequences of inflation. We should never forget what happened in Europe when we had a very high level of inflation. Once again, this is an unprecedented level of inflation since the creation of euro. There is a necessity to decide. There is a necessity to have a global action plan and an economic response which is not limited to one single decision or one single action from every member state, but which is based on a global framework on which I'm deeply convinced that we can find a compromise and an agreement.
And of course, a lot of this is back to energy, and one of the components here has been nuclear. And nuclear for France was everything. It was about the sovereignty of the country. EDF, this is an emblem of Made in France, but when you look at the fleet, half of it is not working. Electricity production is not really working for the French either. You're paying a lot of money for this. You have new management coming in. You know the criticism that this company has been very badly managed. Is it going to change? Are we going to see a turnaround at EDF?
It's going to change because we have a new management for EDF. And of course, the first mission of the new management of EDF, Luc Rémont will be at the head of EDF, is to have those 12 nuclear plants being reopened as soon as possible. I mean, by the beginning of 2023, we want all these 12 nuclear plants being reopened because there is a need for nuclear plants and there is a need for nuclear electricity. If you want to face the necessity of fighting against climate change and having those radical changes in the way we are reducing CO2 emissions, there is a need for nuclear energy. And I really think that the mix of nuclear energy and renewable energy that has been proposed by President Macron is the right strategy for France and might be the right strategy for many member states.
Maybe that's a hint to Germany, which is, of course, debating what to do with nuclear. But going back to France, of course, you mentioned now your country. You've put out your budget. You know some of the reaction to it. Perhaps it's too optimistic. You say you don't want to talk down your economy. How do you defend a budget in such a complex scenario where you're still more optimistic than the average? I mean, the numbers speak for themselves.
I'm just defending my budget looking at the current situation in France. The level of growth in 2022 should be 2.7. There was many observers explaining that we would never reach 2.3 or 2.4. We have 2.7% of growth in 2022. We are creating jobs. The level of investment of private companies remains pretty high. So that's why I'm so much optimistic, so much determined to provide growth to France for 2023.
You say the naysayers will get it wrong, but just as a final question, because this also feeds into this budget and fiscal responsibility, the pension reform, I'm sure you knew this was coming. It's a perennial issue for the French government. There's many out there who say the window is just closer and narrower, and you're not going to do this as you hike energy bills, so you have 2 months to get it done. Will this pension reform happen? Will it go through this year?
Yes.
Yes, clear answer.
Yes, my response is yes. The pension reform will enter into force next summer, summer 2023. We have been promising this very important reform during the presidential campaign, and we will stick to our promise.
Well, and of course, we'll speak if it goes through again, I'm sure, to talk about whether or not it actually does improve the fiscal finances of France.
Of course.
Mr. Le Maire, thank you so much for joining us on Bloomberg. Always good to see you. And Francine, that was the French Finance Minister, Bruno Le Maire, joining us here as this Eurogroup continues on day 2. And you can see there's a lot to talk about in this one.
There is a lot, and a lot of times, great interview, Marie, a lot of times we look at it, of course, through the market's lens, but Monsieur Le Maire, they're saying very clearly it has huge political implications. Actually, if you see higher inflation, it could really break governments and change election results. Maria Tadeo in Luxembourg for us. Now, coming up, the tax cuts may be gone, but the vast majority of Liz Truss's economic project remains. We'll get the city's perspective on the plans. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Australia's central bank has surprised investors by raising rates at half the pace expected, sending the Aussie dollar and bond yields tumbling. The RBA ended a streak of half percentage point hikes, opting instead to raise the cash rate by 25 basis points to 2.6%. Only a quarter of economists polled by Bloomberg did predict the move. Now, the judge in the Theranos fraud case has decided to delay the sentencing of former CEO Elizabeth Holmes. He wants to review the testimony of a key witness for the government, former Theranos lab director Adam Rosendorf. Holmes has argued she deserves a new trial after Rosendorf allegedly showed up at a home in August trying to speak with her about his testimony. Bloomberg has learned that the Biden administration is planning to announce new restrictions on China's access to U.S. semiconductor technology. Sources say the Commerce Department will roll out a package of rules this week to govern which semiconductor technologies can be exported to China. Under current guidelines, U.S. chipmakers can sell machinery for use in China under certain circumstances. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, the UK government has, for now, abandoned its plan to cut the highest rate of income tax. But that policy only a small part of the so-called new economic deal that Prime Minister Liz Truss wants to set in motion. Now, to get the city's perspective on this plan, we're joined by Mark Austin. He's partner at Freshfields, also helped write a paper on what regulation is needed to kickstart the IPO market here in the UK and London. So, Mark, thank you so much. We did a wonderful podcast together, actually, about a month and a half ago, and we were talking about why Amsterdam, in certain cases, doing so much better than London. And since we had proposals from the government, where are we now in terms of attracting IPOs and getting things through the pipeline?
Well, I think there's a really good conversation going on, actually. And actually, the whole sort of policy direction, stated policy direction of this government has been very helpful.
Yeah.
The new music around actually needing to do things a bit differently, actually encourage growth and be bold and brave where perhaps we haven't been before, challenge some orthodoxies, I think is something that the city generally is leaning into and thinks is a good thing to embrace.
But not the smart money. This is the problem, is that you know, they maybe went too far in some of the policies. And does it mean that they'll have to roll out some of the anti-regulation rhetoric that was for the City of London, not for the tax cuts for you know, the elite?
I don't think so. I mean, I think the deregulation sort of mood music, I think, is helpful because I think that's the tenor of the city at the moment. I mean, across the top, things like tax cuts, etc. That's a sort of political point. Bankers' bonuses is a more political point. But there are lots of they're effectively non-political points that sit underneath that, because whether you're left-wing, right-wing, centrist, actually the future success of the City of London, given its contribution to the UK economy, tax take, jobs, general economic growth, is a no-brainer. And so actually, the conversations, the reform conversations that are taking place in the city at the moment, I think everyone's quite heartened by the direction of travel of this administration.
I mean, it's a no-brainer unless it's consumers that pay the price. So there's also talk about, regulators coming up with rules and then ministers being able to supersede them or to say, actually, no, we'll do it this way. Is it consumers and the common man and woman that could pay the price for that?
I don't think so if we get it right. I mean, the FCA, for example, has a statutory objective of consumer protection. Right. And clearly, given the macroeconomic and geopolitical environment at the moment, consumer protection is a key tenet of everything we need to do. So we need to reform, keep the city relevant, but also make sure we have appropriate protection. But the key is, what the real thing in the question in that is, how do you get that balance right? And actually, there's probably a discussion to be had around in the capital markets in London. Perhaps that balance should be slightly more nuanced than it is in some other areas. For example, you and I as mortgage holders and interest rates, etc. But actually, my mother in Yorkshire, thinking about investing in an investment product, perhaps the balance should be slightly more weighted towards risk-taking in the capital markets, which I think is something in London that we've slightly lost in recent years.
So what do you think the concern is now? So you were telling me that Amsterdam, for example, is much more nimble in pitching for some of this stuff, so they're attracting, of course, business. But because of the U-turn, which is different to what we're talking about, so this is not for the city, but because of the U-turn, do investors kind of think, well, I'm not sure what's going on in the UK right now?
I think there is a little bit of a question around that, yes, around the investability of the UK. But that is a perception point as much as anything. And actually, a lot of the conversations that are happening now are seeking not just to reform the black letter law, black letter regulation, which is what my review is about, it's what Hill was about, it's about what also the other reviews were about. It's actually about changing the narrative in the UK, changing the perception of the UK, and making it clear that we are a insurgent, fleet of foot, appropriately protected, well-regulated environment that nevertheless offers the best place for companies to come and list.
So where do you think we'll be in that review? I think some things are going to Parliament. We have a new city minister.
The city minister has a lot of energy. He's great. I mean, he's been going around talking to everybody, and he's very embracing of this drive. And I think that that whole reform agenda is going to move forward with some speed. And there's a lot of people in the city who are feeding ideas to that, thinking actually about what can we, given the welter of stuff that's going on at the moment, the danger actually is there are so many conversations that they all get lost or that they cross over each other. And so actually part of the art at the moment is working out what are the things that we can do in the shorter term that have the maximum impact for the city as a whole.
And would this be actually reversing, I guess, maybe some of the talent loss after Brexit, or this is a new set of rules?
No, it's reversing some of the talent loss, but it's actually not new sets of rules, it's actually, I think, refining sets of rules and actually working out. London, for the last 20, 30 years, has built up an architecture that it could bear when it was necessarily the default, in most cases, the default financial centre, default listing venue in Europe. It's not necessarily that anymore, as we've discussed before. And actually, the conversation is about, in order to keep London relevant, as relevant on the global stage for the next 20, 30 years, what do we need to do in terms of being more nuanced and thoughtful about our rules, more principles-based in how we reform, rather than actually necessarily tying companies up and investors up in black letter.
I mean, I think there are like 15 or 20 points of what we should do. What do you think will get done in the next 12 months? What do I think will get done in the next 12 months? I think that we will see regulatory reform completed, so that by end of Q2, Q3 next year, we'll have a regulatory system that's more or less bears comparison with any other listing jurisdiction in the world. That will happen. I think we will see some further conversations around investor attitudes in London. I think we'll see some further conversations around pension investment, greater DC pension investment in markets. I think we'll see some more conversations about tax breaks, joining up across public and private capital markets in terms of the tax system that we have. I think there's lots of quite sort of, I hate the phrase, but sort of easy wins that can happen in terms of actually just changing the narrative a bit. Are you still speaking to the government now, or are they distracted by everything that's going on?
No, they're fully engaged. They are fully engaged. I mean, there's a lot going on.
So you think we could see something in the next, even couple of months? Is it something that could be done before the end of the year?
I mean, there's a lot of conversations going on. It's not for me to say when they will come forward with any proposals, but there is a lot of activity and a lot of very good conversations happening.
All right, Mark, thank you so much. Mark Austin, their partner, Freshfields, of course, also one of the main authors of this review, and a good way of looking at the City of London. So we'll get him back on to bring you all of the very latest on that. Now, coming up, we'll be looking at the top market moves this morning as a global rally continues. This has to do also with some weak data we had in the US. The stocks, bonds rallying, the market now pricing in a peak rate wager, which is lifting off a lot of these markets. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's take a look at how the markets are moving after a global rally extended into a second day, lifting U.S. indices, futures, and European stocks. Well, joining us now is JP Barnett. JP, what's driving the bounce?
Well, yesterday we had some weak economic data out of the US, which sounds counterintuitive. But the market took this as a sign that the economy is cooling and that this maybe creates a pivot point for Fed policy and for the rates to go down. So it's actually a positive thing. But when I read about it, I still thought it's a bit of a silly reason to belong in risk assets here. But it shows you the sentiment was so bearish and everybody was kind of keen to buy the dip and was just waiting for a good argument to do so. And now it was that data point that they picked, and we see a nice little rally there.
So, JP, can it last? And if not, what is needed for it to do so?
Well, that's still the big question. I'm a little bit cautious if it really can last. We have bearish positioning, as I said, and that can drive some rallies over a couple of days or even weeks, as we have seen during the summer. But to really endure that rally and to bring a change in sentiment, more importantly, I think we need more data points. We need actually probably some hints from the central banks that they are nearing a point where they are willing to at least ease down on the rate hiking. We want to see inflation coming down. Let's not forget, estimates are still for a brutal move lower in inflation next year. So if those estimates start to be believed, then we could see the rally going a bit longer.
JP, what's your take on Credit Suisse right now? The hot take?
Well, a hot take is the bank is really borderline right now. It's in danger of fully losing the trust of its investors. It needs to make a bold announcement now, not exactly a fast one, but one that has substance, that has a real strategy behind it, and that can reassure the trust in the bank to be profitable in the long term. Because otherwise, there will be in a vicious cycle of losing trust, higher cost of capital, losing clients, losing profitability, and this will go on and on and on. So a bold statement here is needed at the end of the month or earlier.
Great. Thank you so much, JP Barnett there with the very latest on some of these moves. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz are in New York, Anna Edwards here in London. Now, the focus, not only what we heard from the RBA, but of course, peak expectations for hikes at the Fed. A couple of other things we need to watch out for. A great Kenny Donaldson story saying that Liz Truss will struggle to drive through key parts of the economic revolution she's planning for the UK because her standing in the ruling party is already so damaged. We'll also cross over to Birmingham with our Lizzie Burton. This is Bloomberg.
We are starting to see some companies rip off the earnings mandate.
It's really, I think, important to be forward-looking.
I'm not sure what's normal in today's environment.
We are growing a little bit more nervous about that consensus trade.
It is kind of a bearish opera, and the conclusion is that the opera ain't over until the Fed lady sings a more optimistic tune.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Shock down under. A smaller than expected rate hike from the RBA fuels the debate over whether the end of tightening could possibly be near. Top EU officials raise the possibility of joint debt to tackle the energy crisis, but more hawkish members of the bloc are strongly opposed. We're live in Luxembourg as ministers meet. And Credit Suisse's options go from bad to worse. Investors want to know how the bank will pay for a major restructuring. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, it seems that bad news yesterday on the US markets, on Wall Street, manufacturing in particular in the US. Bad news seems to be good news for risk assets once again.
Yeah, it does. It feeds into the narrative that if the data turns, then central banks won't be quite as hawkish. And the market kind of got confirmation of that from the RBA in Australia overnight, delivering a hike of just 25 basis points, so ending their streak of outsized rate hikes. And that
had an impact across asset classes. Of course, you still had China and Hong Kong closed for holidays, but stocks up 3% in Japan, and in Australia up 3.25%. The best day for Australian stocks going all the way back to June of 2020. Where the real impact was, though, was in the bond market. That 2-year yield in Australia coming in nearly 32 basis points just in a single day, down to the 314 level. And interestingly, the Aussie dollar was stronger against the U.S. dollar, given that the U.S. dollar seems to be weaker against mostly everything. But as you've seen less hawkishness on the central bank front, it is a weaker Aussie dollar against the U.S. dollar this morning by about 0.2%, trading around the 65-cent level. So one central bank has kind of pulled back the gas pedal, Matt. The question is when all the rest are going to follow.
Yeah, one down, everybody else to go. Nonetheless, market participants are bullish. At least futures are trading higher after the cash trade rose up yesterday. We're looking at a 1.5% gain again in futures. We still have 4.5 hours to the open, but that's a very strong reading for this time. Right now, 10-year yield coming down. So that does mean that investors are buying treasuries. Ray Dalio says cash is no longer trash, and I think that extends probably to the treasuries world, maybe not out to 10 years, but certainly earlier on in the curve. Right now, 357.95 is what you see on the benchmark treasury. And then gold right now up another 0.5% at 1709 after really a huge rally. I think it was up 2.4% yesterday, which doesn't sound like a lot, but it is a massive rally for gold. Back up over $1,700 at 1709. The Bloomberg Dollar Index is coming down, and you can see that in Bitcoin as well, although it still has yet to pierce the $20,000 mark again. Right now up 1 2/3%, 19,913. We're going to be watching this very closely, Anna, because Kailey and I have our crypto show today at 1 p.m. this afternoon.
Absolutely. So crypto in focus, no doubt for that reason. Matt, this show should be provided with shades, such as the brightness of the green. For our radio audience, I'll just fill you in that we've got green across the board for European stocks today, up by more than 2% on a number of major markets in Europe. This is a bit yesterday's story because we're following on from what happened on Wall Street yesterday with the worse than expected manufacturing data, sort of reigniting that talk about a Fed pivot. So that is part of the story, but it is also pricing in, as Kailey says, the narrative from the RBA, one central bank down, others could follow. Is this premature? We will see. But markets certainly running with this story for now. Let us have a look at a deeper dive into other European assets. And this is what we have on the UK 2-year. The 2-year yield once again coming down. We're seeing buying of debt products across the curve, but in particular at the short end in the UK. But this is actually part of a global story more than just what's going on in the UK today. The natural gas price for Europe down by 2.3%. It was actually down by quite a lot more than that earlier on. And that really because of some pretty mild, very lovely weather that we're having in parts of Europe today, and as a result reduces worries at the margin about the winter and gas storage levels. Credit Suisse up by 5.8%. We put this in again today because of the big moves we saw yesterday and then the recovery in the stock. So it was down as much as 12% in session yesterday. Those CDS, the cost of insuring against default, went to a record high. And then we saw those losses in the share price paired. And this was all on the first day of the new CFO at Credit Suisse. So a busy time and a lot to get stuck into, no doubt, over at Credit Suisse. More on that story shortly. Drax Group, this is interesting. This company is an energy generating business here in the UK. It was down yesterday in anticipation of some negative media coverage around its environmental record. The company's pushed back strongly against that. But actually today's sell-off is all about whether we will see another U-turn, Matt, from the UK government. They U-turned on the top rate of tax. Will they U-turn on their declaration that they wouldn't put windfall taxes on power generating businesses, Matt?
Right. Everyone seems to be pushing even harder after they got that first U-turn. Let's get to the RBA's pivot right now. A dovish surprise, it's being called. Australia's central bank ended a streak of 0.5 percentage point hikes, opting instead to raise the cash rate by only 0.25%, 25 basis points to 2.6% in total. Only a quarter of economists that we polled predicted that move. Andrew Ticehurst, a rate strategist at Nomura, says the RBA is clearly dancing to its own tune. So is this a sign that peak rates are near? Let's get more with Bloomberg's Danny Berger. Danny?
I love that idea. Is this just the RBA out on its own? Well, it's certainly not what the market has interpreted because of the impact across global bond markets. But let me first put the size and scope on the Aussie bond move itself. 3-year yields plunged, the biggest intraday fall since 2008. So that just shows you what a surprise this was to this market, but not just a surprise. It is a market where we've just seen carnage to global credit. So it really is a lot of bad news priced in. Any sign of sort of a soft pivot narrative seems to send bonds higher, as we saw yesterday with weaker manufacturing data. So it wasn't just Aussie front-end yields. It was across the globe, from the UK to the US. We really saw this big plunge in bond yields. Even Germany down 13 basis points for the 2-year yield. Again, it is a market, whether it is the economic picture worsening or financial instability that they're hoping will make central banks pivot. This is what the market is pricing. But again, the market is pricing something different than what Fed officials are saying. We heard from Barkin yesterday saying that they need to continue to hike, that this environment is different. Williams saying that they're not yet in restrictive territory. They need to keep going. Even so, we've priced out about 80 basis points of hikes for year-end next year. So what the market is doing and what the Fed is saying are two very different things right now, Kailey.
All right, Bloomberg's Danny Berger, thank you so much. Staying on top of those market moves, let's stay on top of the politics story as well in Europe. European finance ministers are meeting for a second day in Luxembourg, with energy taking center stage. The bloc is considering ways to tackle the crisis as Russia cuts gas deliveries and the continent prepares for winter. We spoke with German Finance Minister Christian Lindner.
We have to make efforts to strengthening our common purchase on the international markets. We have to change the order of the electricity markets, but our package is not unproportionate. In fact, it is proportionate.
Bloomberg's European correspondent Maria Tadeo is joining us now from Luxembourg. Maria, you also in the last hour spoke with the French Finance Minister Bruno Le Maire, who told you he's not talking about common debt issuance, but he's talking of raising money with a guarantee of all states. What was your takeaway from the conversation, what the difference is between those two things?
Yeah, and Kailey, let's just, because this is very complicated and there's a lot of jargon in all of this, as it often happens in European discussions. If you go back to the fundamentals, the issue here is that all of these European countries agree that energy prices and bills have to go down, but they do not have the magic formula that works for all of the countries. There has been a number of things happening over the past week. You have the Nord Stream that exploded, and then you have the Germans that came up with a mega package of 200 billion euros to prop up their economies and their households. Now, that has created concerns in the euro area, with a number of countries suggesting behind the scenes that Germany has the fiscal space that other countries do not, and this could create disruptions within the union, but also be a problem for the level playing field across the euro area. And that's where the French come in. They say, we don't want to criticize the German plan. They have a right to defend their domestic economy, but we have to do this in a way that's coordinated. Now, he does not talk openly about joint debt for the time being. What he says is that Europe could come up with a mechanism that could essentially put out loans backed by the EU that could then be reset and provided to different member states. So this is incredibly complex, but going back to the fundamentals, it's the issue that a number of countries have been taken aback by the size of the German package, by the lack of communication from the Germans, but also this idea that come the winter, it cannot be every man to himself.
Okay, and so is there a sense that unity has been rediscovered then, Maria, in Luxembourg, or do they still remain very divided on the extent to which countries should be able to go it alone?
Well, and funnily enough, Anna, I can't tell you the amount of times I've heard the words unity, solidarity. We have to stay together. The sanctions are working because we've done this together, and so far this has been essentially validated by the fact that these decisions are taken unanimously. To me, was striking today when I spoke to the German finance minister, who was in damage control, telling me there has been a misunderstanding. The package is big, but so is the problem for Germany. Everyone else is doing this, but he was very clear on this idea that I do not see how more debt will fix this problem. So this is a conversation, Anna, that I'm sure will evolve in the next few weeks, and this is not the end of it by any means.
All right, Maria, thanks very much. Maria Tadeo there reporting from the EU Finance Ministers meeting in Luxembourg. Now, let's get back to the banks. Credit Suisse shares trading higher today, just one day after touching a record low. The Swiss lender's credit risk gauge jumped to an all-time high yesterday after the CEO, Ulrich Körner, failed to calm markets on capital levels and liquidity. Stephen Ahrens, Bloomberg's finance reporter, joins us now out of Frankfurt. So, Stephen, how serious is the danger to Credit Suisse?
Well, clearly the market is extremely nervous. There's a lot of speculation about Credit Suisse. There's even speculation about capital, how much capital will it need to raise for a big restructuring they're planning. The CEO, as you said, he sent out a memo to reassure people. The bank is talking to people to make sure they understand it's in a solid capital position. But again, the uncertainty is really, really big, and there's a lot of uncertainty generally in the market about the macroeconomic environment. So it's a volatile and difficult situation that Credit Suisse will need to manage over the next few weeks.
Yeah, and Stephen, it's still a few weeks, as you say, until we get the details. Meanwhile, the roller coaster ride continues. Stock down substantially, as much as 12% yesterday, jumps back up 5.5% today. What's next to watch?
Yeah, exactly. I mean, it's a roller coaster. And the executives, I mean, you just said it, they have a new CFO who started just yesterday. He came from Deutsche Bank, and he's got, luckily, he's got good experience managing the CDS price, a volatile CDS price, because he used to be at Deutsche Bank. And so everyone's watching for something to happen, for more guidance on what could come, comfortable with the capital levels of Credit Suisse. And the question is if Credit Suisse will be forced by the market to make an announcement before they actually plan to do so at the end of the month when they present third quarter earnings. The market pressure could become so big that they will have to say something before that.
All right, Bloomberg, Steve Ahrens, thank you so much for your reporting on Credit Suisse. Another company we're watching this morning is Tesla. Kathy Wood's ARK Investment Management bought over 130,000 shares of the electric car maker after they plunged when third quarter deliveries missed expectations. It's the second time ARK has bought the dip in Tesla this year. A few other stocks are moving in pre-market trading as well, as we have Tesla up about 2.7%. And they actually are all also automakers, and specifically EV makers. One of them being Rivian Automotive, which of course is another big EV maker. It, after the bell yesterday, reaffirmed its production guidance for the year, expects to make 25,000 vehicles. As a result, that stock is up 7.5% before the bell. You have another EV maker, Lucid Group, higher by more than 2% as well. And then finally, Stellantis getting a bid too, up 3.6%. Matt Miller, Merry Christmas. All car stocks for you this morning.
Thank you so much. That's so kind of you. Anna, what have you gotten me?
Yes. I have you a conversation about the weak dollar. This is more for me than for you, isn't it, given travel plans? But yes, a little bit of weakness in the dollar. We'll talk about that with Kit Juckes. Is it premature? Goes hand in hand with all the risk appetite we're seeing globally today. Kit Juckes joins us from Societe Generale, Chief FX Strategist. And we'll also talk Brazilian politics, the Bolsonaro bump. Perhaps Brazilian equities are soaring after the incumbent's better than expected showing in the first round of presidential voting. Is it all about him, or is it about the tack to the middle that both contestants might make? More on that ahead. Plus, waiting for an encore after emerging from the pandemic on top, Pfizer is coming under pressure to produce its next big hit. Read more in today's Big Take story. That's on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here with Kailey Leinz in New York, Anna Edwards with us out of London. Now, my heart goes out to anyone who needs to refinance a mortgage in this market, especially in the UK. I don't have such emotional feelings about companies needing to refinance debt as they probably should have done it any time over the last 2 years. But this is still a problem. We're looking at refinancing debt at a cost that's more expensive than it's been in over 22 years. This chart goes back to when I was hired here at Bloomberg, and we've never seen a cost to refinance this high. Priscilla Azevedo Rocha, Bloomberg's credit reporter, joins us now to talk about what this means for the markets, what this means, Priscilla, for the broader economy, and what it means for companies.
Hi, Matt. Yes, that's right. It has become really expensive to refinance your mortgage, to refinance your bonds. It doesn't matter what type of debt you have now, it has become more expensive. So markets have changed. So that means the companies, they're going to have to rethink what they're going to do when they need to raise finance. Either come to the bond markets at more expensive prices or with higher costs, or look elsewhere for financing.
Good morning to you, Priscilla. And I suppose it's for this reason, because of this blockage that European corporates have run up against, and global corporates to some degree have run up against, that the market got quite so excited about a small pivot perhaps from the RBA. So if the whole world is looking for when a central bank's going to pivot away from the laser focus on inflation to, oh yes, growth is actually also a concern, we saw a little bit of evidence of that. Is expectation of this having global relevance, though, is that premature?
It can be a bit premature when we're looking at Europe, because the European Central Bank is way behind other central banks in the hiking path. So there we have a little bit of dissonance. But when we're looking into the Fed and the US, perhaps now the discourse is that they're going to continue hiking. That's at least what economists are expecting in the market. But maybe once that can provide like a little silver lining and the attention turns back to growth.
Okay, Priscilla, so that's what's going on kind of the macro scale. If we focus on some individual stories, the one that has captured all of our attention over the last 48 hours or so is Credit Suisse. What is going on with CDS today?
Well, CDSs today, they have eased slightly, so they're not rising. So the risk of defaulting from Credit Suisse, they're not as high as it was yesterday. They're still like, but this is in line with broader markets. So we need to understand that market sentiment today has improved slightly. There's some better news in the market. So investors are less anxious than they were yesterday. But what we've seen yesterday was a sign of concern. So investors, they're ready to act, and they're showing that they are watching, and they are watching Credit Suisse for the next steps.
Okay, Priscilla, thanks very much. Priscilla Azevedo-Rocha with the latest on credit markets. And for more market analysis, check out MLIV Go. That is the function on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Australia's central bank surprise. A smaller than expected rate hike fuels the debate over whether the end of tightening could possibly be near. Top EU officials raise the possibility of joint debt to tackle the energy crisis, but more hawkish members of the bloc are strongly opposed. We're live in Luxembourg as ministers meet. And Credit Suisse's options go from bad to worse. Investors want to know how the bank will pay for a major restructuring. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, the market certainly jumping on with enthusiasm. The weakness in the data yesterday for US manufacturing. And of course, we've got plenty of jobs data due this week, really raising questions about whether that sort of bad data impulse continues and how good that could be for risk assets.
Right. Although, you know, we really had some tailwinds behind risk assets even before that data came out. I mean, remember over the weekend, Julian Emanuel from Evercore ISI said, it's time for a bear market rally. And boy, was that great timing from Julian. Take a look at S&P futures. After the big rally that we saw yesterday, we're building on that with a 1.5% gain. Of course, we're still 4 hours away from the market open, and a lot can change. We have seen a lot of volatility in futures ahead of the open over the past few weeks and months, but still a very positive sign. On the other hand, investors are buying the 10-year paper, and they're buying really debt across the curve. So that's pushing yields down about 6 basis points to 357.95. That's maybe good for risk assets. Those rates coming down a little bit. And then gold, after a big strong day yesterday, up 2.5%. It's up another 0.5% today, up over the $1,700 mark as the Bloomberg Dollar Index falls lower. The same is true with Bitcoin. It's had a good day so far, up 1 2/3%, but still not piercing the $20,000 level. So Bitcoin at $19,924. The interesting thing about this is, and we talk about this on the crypto program, we're going to talk about it again today at 1 p.m., is that Bitcoin has held up while most other risk assets in the past few weeks have come down with the pound and with gilt. So it's very interesting to see that this has been a fairly safe haven, as has gold during the mini budget fiasco in the UK. Kailey, what do you see in terms of the pre-market movers?
Well, there are some crypto-related equities gaining with that move we are seeing in Bitcoin, but you also are really just seeing large gains for large cap technology stocks, including Tesla, which of course had a big down day yesterday after deliveries disappointed for the third quarter. But then Cathie Wood, ARK Investment Management, comes in to buy that dip, and that is helping give a little boost to the shares this morning, up about 2.9% in pre-market trading. But of course, with rates moving lower, yields moving lower, that's really giving a lift to the big tech complex overall. Apple up 1.6%, Nvidia, the chip maker, by 2.6. You got Amazon moving to the upside by about 2 percentage points as well, Anna.
Yeah, so yields lower and the dollar a little bit lower, giving room for risk assets to rally. Then, Kailey, and we had that, as we've said, bad news out of the US, the manufacturing sector yesterday. And the European market's just catching up with that story this morning, but also adding in enthusiasm around the RBA. We've talked about it a few times. We'll talk about it shortly with Kit Juckes. But what does it tell us, if anything, about the appetite of other central banks to perhaps pivot from jumbo hikes to something a little bit smaller? The UK two-year yield, just sort of indicative of the global story then. We're buying stocks today, also buying government debt, particularly at the short end. We see that, though, the trend is to some degree consistent across the globe. We're seeing it happening in other parts of the world as well. Natural gas prices coming down 2.6% here in Europe. They were down more than that earlier on. Slightly milder weather here in Europe, underlining how things could be better than anticipated for Europe over the winter if that were to continue to be the case. And Drax Group, a power generating business, down by 5.4%. There are questions now being asked if the Conservative Party has pivoted on the top rate of tax, Kailey. If they're not sticking to that plan to cut that tax rate, then will they also stick to their plan to say that they won't tax in a sort of windfall way the profits of these power generating businesses? So that's certainly something that the market is still thinking about, Kailey.
Yeah, and let's get other market thoughts now with Kit Juckes, Societe Generale Chief FX Strategist, who is now joining us. Kit, I'm sure Anna's going to want to speak with you about the UK in just a moment. If I could just start in Australia, though, the RBA surprising by delivering just 25 basis points in terms of hikes overnight. That seems to be a pivot from one central bank. Do you read into anything as to whether or not others are going to follow them on that front?
No, I mean, in a sense, the RBA's got form of wanting to be less hawkish than some. So it's one of those surprises where you look and say, oh, they would do that, wouldn't they? We'll see what the RBNZ does next. But no, I think, look, it's a much more open economy, much more traded economy than the United States. That's a big difference. So they're more affected by what's happening elsewhere, and concerns about the slowdown in China are something they want to watch. So I think they've bought themselves time. They haven't got as much inflation in their economy as some of us have either. So they probably feel they can afford to. And I suspect that's what this is, a temporary slowdown rather than a permanent pivot, if that's the right way to look at it. Because I expect the economy is going to go on doing well.
So, but something has certainly ignited risk appetite over the past 48, 24 hours, Kit. I mean, the weaker dollar, lower rates, this all allowing space for risk assets to rally. Does this look like some sort of bear market rally to you? I know this is slightly away from your FX field, but in terms of the broad sentiment towards risk assets, does this look long-lasting or just a sort of blip?
Lasting long enough to cause some pain to some people, but it's still a bear market rally. Look, I think it's the fourth one we've had this year, to put it in context. The bond market drives everything. So the 10-year note yield has been pushing up. The last correction we had was in June, July. We've had a straight line rise in equities, in bond yields in August, September, that took the dollar up. So took the dollar up in a pretty straight line as well. So sharp move higher in yields. More than 10% rally for the dollar, fall of more than 10% for the S&P, in a pretty straight line that sucked everybody into short euros, long dollars, short sterling, a whole load of trades that all reflect that. And now that we're getting a correction and people talking about, what do we care about the manufacturing data, we're going the other way, and we could go quite sharply. But the thing to look at in the United States, for me, is not the softness in manufacturing that we've seen. The ISM manufacturing numbers unambiguously pretty soft. It's what's happening with the consumer, which is the most important thing over the next few days. So the labor market data matter more. The services ISM matters more. Today's jolts matter more than yesterday's numbers.
Okay.
The consumer is okay, as far as I can see.
Okay, so we get the JOLTS data, we get claims data, we get the non-farm payrolls data as we move through the week. Plenty of jobs data points to watch for. Something that has been whipsawed a little bit during September, though, Kit, has been sterling. And I wonder where you think we are on that story right now. We're almost back to levels that we started September at, but not quite. I mean, 113.42 on cable at this point. Where does it head into the end of the year, Kit?
I think it follows the euro now much more. In other words, it becomes less of an independent UK story. I was in Asia last week. I don't take a slide about the UK particularly with me to Asia, and it's all anybody wanted to talk about for a number of days. Completely sort of everybody trading it, and I think everybody short of it. And I think that move is finished. So I think euro sterling is now going to be settling into a range. The determinant of what happens to cable over the rest of this year is more than anything else going to be what happens to the dollar broadly, but what happens to euro dollar. If it's a cold winter, the euro and the pound are both going to suffer from concerns about blackouts. If we escalate the war in Ukraine, that makes things worse. If that quietens down, it gets a little bit better. Those are the drivers of sterling, and possibly we won't have to talk as much about Liz Truss and Kwasi Kwarteng for the rest of the year.
What about the U.S. dollar, Kit? I mean, we're heading in to midterms right now. We're starting to see things change, as the surveys pointed out yesterday. I heard from Tim Fiore that over the past few months, there have been 8 times more companies looking to hire than looking to freeze or reduce labor. Now it's 2 times more companies looking to hire than to freeze or reduce labor. So is there any bear case for the U.S. dollar here?
That it's really, really expensive. So the short-term bear case is pretty clear. We've come an enormously long way. But it's hard to believe that we've seen the highs or the end of this move when household balance sheets are healthy, when the tightness of the labor market is going to keep upward pressure on inflation as it spreads through more bits of the economy, so it won't come down enough. And where the Fed, frankly, having not had to fight inflation for very many years and having got itself a little bit behind the gain line in that fight, is going to be terrified of pivoting too early. So I suspect that if we see any signs of anything still strong in the labor market data and so on, that the Fed's going to reaffirm its commitment to make sure it defeats inflation, even if the economy has to slow. I think that makes it a really tall order to say, yep, this is the moment the dollar has peaked. I think it will peak in the fourth quarter of this year, but I think I would certainly want to take a view on the U.S. economy off the household sector and consumption rather than off particularly manufacturing, particularly the international-facing sectors.
Okay, so the dollar peaks this quarter, and we look for clues in the consumer. Kit, thanks so much for your time. Kit Juckes of Societe Generale, great to speak to you today. Coming up, we'll turn to Brazilian assets. Brazil's bump assets are soaring after Bolsonaro's better than expected showing. More next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Micron's CEO. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Now, Brazilian assets are getting a boost after incumbent Jair Bolsonaro secured his way to a runoff election against Luiz Inácio Lula da Silva. Investors cheered on Bolsonaro's better than expected showing and bet his challenger Lula would be forced to moderate his stance in the second stretch of the race. Clara Ferreira Marquez, Bloomberg opinion columnist, joins us now for more. So, Clara, it looks like investors want Bolsonaro to do well, or do they just want Lula to be less left?
Well, I think it's a bit of both. They definitely would like to see the pursuing of some of the reform agenda that we saw promised by Bolsonaro, certainly in 2018 when he first came to power and when Finance Minister Paulo Guedes was really selling this to investors, so fiscal reform, a lot of things that he didn't actually push through. And then we have on the left with the PT and Lula, really investors wanting to see him push to the centre. Now, it has to be said, this really has been where he's positioned himself since the start of the race, and we know from his track record that he's a pragmatist. He governs from the centre, but of course he hasn't provided a lot of details, so it'll be interesting to see what these assets do as more of his agenda, more of his plan for governing becomes clear.
So what should we expect to see over the next 4 weeks?
Well, a lot more detail from Lula, a lot more vitriol, a lot more violence as well, which will create some instability. But certainly a lot of action. So far from both sides, in fact, we've seen a lot of personal attacks, but not a lot of macroeconomic detail. In fact, they don't really differ on the macroeconomy. It's more on issues like what to do with state enterprises. So it'll be really interesting to see a bit more detail from both sides.
Yeah, they also differ on what to do about the environment, don't they, Clara? Some insight there, perhaps, as to how much that's become an issue, because it's written about from outside Brazil a lot. I wonder how much it's really at stake here.
It's actually not it's not been an issue, surprisingly and disappointingly, for the Brazilian electorate. Really, this is an election that is all about the economy. It's all about high inflation, squeezed incomes, hunger. It hasn't been about the environment, though, of course, both there and during the pandemic, Bolsonaro's record is abysmal.
Clara, thanks very much. Thanks for joining us. Bloomberg Opinion's Clara Ferreira Marquez talking to us about the latest on Brazil. Let's jump from Brazil to the UK. Some members of Liz Truss's top team say the UK Prime Minister will struggle to drive through key economic policies because her credibility is already so damaged. Mel Stride, Conservative MP and Treasury Select Committee Chair, spoke to Bloomberg's Lizzie Burden earlier today.
Under current economic circumstances and given all the spending issues that are in play, undoubtedly it's going to be quite a bumpy road. But I think we need to not put the cart before the horse. I think we need to just settle things down now and take a measured view going forward as these issues arise.
Mel Stride there, somebody who's been calling very loudly for more cooperation between the government and the OBR, that body we mention a lot. Now, our markets editor, Valerie Teitel, joins us and has been looking at UK assets and how they've been responding of late. Valerie, is there a sigh of relief in UK assets? And if there is it to do with the politics, or is it about changing expectations around the Bank of England?
Yeah, thanks, Anna. I want to present a view that the rally that we're seeing in sterling, it crossed the 114 handle earlier this morning, but that rally we're seeing in UK assets is less about the U-turn happening in politics. It's what happened with the Bank of England purchases yesterday. This is their fourth day of purchases, and they only bought 22 million of one single bond. Now, the other side of this is they rejected 2 billion worth of bids. Now, how did the market handle that? It was a test of the market depth, and 30-year yields handled it very well. They only traded weaker on the day by 6 basis points. That shows that maybe the fire sale on gilts is very, very over at the moment.
So, yeah, the fire sale that kind of didn't happen or only happened before they stepped in. What does this mean for the BOE? What does this mean for, the next few weeks in the markets?
Yeah, look, a big sigh of relief at least. We know that now that the Bank of England is less likely to unwind an entire year's worth of QT by these 2 weeks of purchasing operations. But look, the big picture is less the Bank of England needed to buy, the less stimulus they were going to add into the economy, and the less aggressive in hikes it needs to moving forward to undo it. The hike expectations for the November MPC meeting are now down to near 100 basis points. They traded up to a high of 180 last week. Even the terminal rate for the Bank of England has dropped nearly 100 basis points to 5.4%. But look, this bodes well for the BOE's fight against inflation, that it can do so without hiking rates too high, without causing more jitters to the UK's mortgage market. But big picture, it's looking more and more likely that the Bank of England can save face doing this liquidity operation in the midst of a tightening cycle. Look, because it's not too far-flung to say that the ECB is going to have to fight the same thing in BTPs, and hey, maybe even the Fed. We know that Treasury liquidity conditions have been deteriorating rapidly. It bodes well for these 3 big central banks that maybe liquidity operations in the midst of a tightening cycle is something they can get away with.
Okay, yeah, that's really interesting, isn't it? Because it did raise a few eyebrows as to whether different parts of the Bank of England machinery were operating in different directions. Valerie, thanks very much. Bloomberg's Valerie Teitel on UK assets. Coming up on this programme, Elon Musk's plan for peace. The Tesla CEO setting off uproar after tweeting his thoughts on Ukraine. More next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, Tesla boss Elon Musk is under fire for a series of tweets calling for Ukraine to seek appeasement with Russia to end the war. He also called on Kiev to give up Crimea for good. For more on this, we're joined by Bloomberg's Craig Trudell. And Craig, you come at this, of course, not from the geopolitics, perhaps, but what this means for Musk as somebody who sells cars globally, the Tesla business owner. So Musk has previously shown acts of goodwill towards Ukraine, and even in this series of tweets has said, yes, of course we support Ukraine. Look at what we're doing on satellite connectivity. But this latest series of tweets has not gone down well in Ukraine. What do you think it means?
Right. It's not been well received. And you referred to the idea that he's been supportive of Ukraine, not only with Starlink, the satellite internet service, but also sending solar packs and generators soon after Russia invaded. On the other hand, I think there is a sort of view in Ukraine of we already voted on whether or not we want to be independent way back in 1991. We don't need this suggestion for a new vote. Set aside the idea that many people have died, many people have been displaced. So there's definitely a lot of sort of anger, as you put it, ill will reacting to this. And some viewed those acts of goodwill of sending the generators and the satellites and whatnot as just that. Others kind of do look at this a little bit askance and say, hey, this guy has talked about sending ventilators during the pandemic, and he sent CPAP machines. He tried to build a submarine for the Thai cave rescue back in 2018. That ended up being a little bit of a stunt. Is he really just, kind of fishing for attention and trying to insert himself into a disaster over and over again? And well, is this really sort of goodwill?
On the other hand, I mean, sure, if you tell someone who's vowed to fight to the death not to do that, they're going to be angry, especially after they've given up so much already in that fight. But isn't there room at least for one or two pragmatic views out there? I mean, he is saying in his tweets that he's just trying to save lives in the long run. He's just doing the math, right? Because Russia is very large and has a lot of nuclear weapons.
Right, and that's really what Musk's point is here, Matt, to your point is he's after trying to end this. I think the controversy here is his suggestions for solutions, what he's kind of leaving out, what he's overlooking. And certainly I think there's a case to be made that others share his view that the fact that Ukraine is having some success defending itself potentially prolongs this conflict, leads to more death. And certainly there are people who understand where he's coming from here. I think it's really just a case that there are some people on the other side of that debate who really have strong feelings, easily get animated, and for understandable reasons here.
Yeah, and does that mean that those people are not going to be interested in purchasing Teslas because they're affiliated with Elon Musk? It's Craig Trudell, thank you so much, our global auto czar. Thank you for joining us. Now let's take a quick look at what is ahead today and what is on the agenda. The World Aviation Festival, billed as one of the most important aviation technology conferences, will get underway in Amsterdam. You also have the Warsaw Security Forum starting in Poland. It will run through Wednesday, as several European leaders are expected to speak, including German Foreign Minister Annalena Annalena Baerbock. ECB Governing Council member Mario Centeno will be speaking at a conference in Luxembourg at 8:30 a.m. New York time. Then in Fed Speak, John Williams, Loretta Mester, and other regional Fed presidents will be talking at various events. And finally, we'll get some U.S. economic data as well, including factory orders and durable goods orders. And my question, Matt, will be if those come in strong, does that sap risk appetite, as we have seen bad news actually being good news for the market, or will that data come in softer and kind of reinforce the idea the market has gotten in its head over the last 24 hours?
Yeah, I think, we're going to see data points coming in either direction, and maybe the market reacts on a dime, or maybe they take a longer term view, and this is just a bear market rally that's destined to run its course. It'll be interesting to watch when that data comes out.
Yeah, I spoke to one strategist from SEB earlier who described it exactly that, as a bear market rally. And certainly Kit Juckes was telling us the focus on consumer and therefore on jobs is important. That's it for the early edition. More surveillance is ahead. We will be back. This is Bloomberg.